Hey everyone, George here. So if you're a construction contractor or any other business owner for that matter, and you have a flow-through entity like an S corp, LLC, sole proprietorship partnership, one of these, and you make between 2 to 400,000 bottom line per year, this one tax strategy alone can save you tens of thousands of dollars on any given year. It gets really into the weeds, so a lot of tax preparers might not, give you this information, might not get into it. But we're going to go over all that here in this episode. So, stick around. So Section 199A of the Internal Revenue Code is a qualified business income deduction. And it allows eligible taxpayers to deduct up to 20% of their, business income on their personal side, which, it kind of runs in the background of everything else going on between your S corp flow through or LLC flow through income and, W-2 wages, anything else you might have on the personal side. But it's definitely a nice deduction. It lowers the tax bill, and you don't want to miss out on it. Now, the problem with this is with the new bill, there are phase outs. So if you're a single or head of household filer, it starts phasing out at 197,000 of AGI and is completely phased out by 247. And if you're filing as married filing joint, your phase out begins at 395,000 of AGI and is completely phased out at 495,000 of AGI. So, most likely your tax preparer or whoever, if you do your own taxes, won't tell you this. It's a calculation that runs in the background, but it will significantly, if you do phase out of it, if you're at say $400,000 of AGI as a single filer, this will significantly increase your tax bill. So if you are at that 200,000 or 400,000 threshold, I would really watch out for this and optimize things because it can make a huge difference. Now, what can you do to optimize on the personal side? And that's what we're going to go over today. So there's three main strategies that I recommend to help optimize things on the personal side. Number one is harvesting capital losses. And what do I mean when I say that? So if you have a lot of, if your business income is what it is, however, you have a lot of capital gains that year, maybe you sold crypto at a gain, you sold stock at a gain, whatever it is, that can be enough to put you at that 200,000 or 400,000 AGI for that year. So if that is the case, and you do have some, investments that are not doing as well, you can consider selling, the timing of those investments, selling them in the same year as, the year of the capital gain, appreciated capital assets. And that will help, bring down your AGI to possibly the level that you need. For example, if you're a single or head of household filer and your AGI is at 240,000, you could, check your stock portfolio or wherever and see if there's things you could sell at a $40,000 loss, because at 240,000 AGI, you're almost completely phased out of the QBI deduction. And if you could somehow claim $40,000 or more of losses, you can get the entire thing like almost reinstated, like back. So, and it would make a huge difference. And to quantify the difference it would make, it's the QBI deduction is basically 20% of, your bottom line, your taxable income, which is basically your bottom line from the business. So take 20% from the business to just round it between federal and state, take 30% of that, and that would be your take home. So if you had in that one case, let's say $200,000 from the business, like 20%, $40,000, $40,000, what's like, 1/3 of that, so $12,000. So that would save you $12,000 in taxes if you are able to, in that case, harvest, like $40,000 of losses. So what's optimization strategy number two is charitable contributions. It's great to give to charity of your choice, but do it strategically. Again, you could, of course, always write a check to charity or something, but a smarter way to do this is you can always donate appreciated stock, because number one, you avoid paying the capital gains on that donated stock, and number two, you take a deduction for the full fair market value of the stock, at that date of contribution. So same deal. If you could donate, in this case that we, drummed up, if you donated $40,000 as a single or head of household filer, it could make the difference of like a $12,000, tax deduction, assuming that you have $40,000 of stock, or something to give. Now, what's one other quick and dirty way to do this if you don't have actual, appreciated stock or something to give? The quickest way to go about this is going to be any sort of optimization you could do at the business level. At the personal level, there's really only so much you can do. Like charitable contributions, make sure you deducted your mortgage interest, your property tax, like all that. But at the business level, that's where you have a little bit more leverage or leeway with respect to strategy. The quickest way to do this is to buy a capital asset. In that year, assuming that you have the need. Again, don't let the tail wag the dog. Assuming that you have the need, to buy a truck or a piece of equipment or something that could bring you down $40,000, $80,000, whatever, and you don't even need to pay for it all in that year. You just need to actually make the purchase, so that you can Section 179 and bonus the whole thing. And that would significantly help you in bringing down your taxable income from the thresholds you need, either whether it's 250 to 195 as a single or head of household filer, or if it's 495 to 395 as a married joint filer. Whatever threshold you need to cross, that's the best way to do it without having a full-on cash outlay. So there's obviously dozens of other strategies or things you could do, but the thing to be most aware of is if you're in that actual phase out tax bracket, be very cautious. And again, this is not something that kind of sticks out at people right off the bat. It's kind of like so hidden in the weeds, this phase out, that probably your tax preparer wouldn't even go over it, or you probably wouldn't even notice it, if you're doing your own tax returns or however you get it done. But it's definitely there. If you're a single head of household filer, just watch out if you're in that 200 to 250,000 AGI range. If you're married filing joint, watch out if you're in the 395 to 495 AGI range. And if you are, then I really, really recommend either figuring out a tax strategy. You can reach out, you can talk to an experienced CPA, whatever you're going to do, just make sure assuming you are able, get yourself below that threshold so that you don't miss out on the QBI deduction, because it is very significant. 20% of your bottom line times your marginal tax rates, federal and state. So I hope this has been helpful. Click like, subscribe, turn on notifications for any updates, and hope to see you in the next one.